By 2007, BlackBerry was not just a smartphone. It was the power tool of presidents and CEOs, commanding nearly half the US market and a $60 billion empire. How could a company so dominant inflict its own catastrophic $50 billion wound? The answer reveals not just a business collapse, but a warning about what leaders miss when they defend the past. The real story begins before the fall. BlackBerry's grip on the smartphone world was absolute. By the mid-2000s, nearly half of all smartphones sold in the United States carried the BlackBerry name. The company's devices lined the pockets of Wall Street executives, White House staffers, and G7 leaders. Security agencies in Washington and London insisted on BlackBerry for encrypted email and secure messaging. News headlines coined a new term, crackberry, to describe the intensity of user attachment. For millions, the blinking red light on a BlackBerry meant business could not wait. Market share charts from the era show a company towering over every rival, its dominance clear. In 2007, BlackBerry controlled about 45% of the United States smartphone market. Its global presence was growing too, with annual device sales surpassing 50 million units at the peak. Investors poured into BlackBerry's parent company, Research in Motion, driving its stock from just a few dollars at the turn of the century to over $140 per share. At its height, BlackBerry's market value topped $70 billion, making it one of the most valuable technology companies on the planet. In boardrooms and airports, a BlackBerry was not just a phone. It was a status symbol, a badge of professional credibility, and a lifeline to the office. The company's reputation for bulletproof security and productivity made it the default choice for organizations where information was power. This was not a fleeting trend or a passing fad. It was the foundation of a global empire, built on trust, reliability, and the promise of always-on communication. Inside BlackBerry's headquarters, every design decision centered on the needs of the working professional. The physical keyboard was sacred, and engineers and executives alike believed nothing matched the speed and accuracy of tactile keys. Mike Lazaridis, the technical co-founder, insisted that business users needed to type long emails on the go, and that nothing else could deliver the same efficiency. Security was treated non-negotiable. The company's encryption protocols were woven into every device, earning trust from governments and major corporations worldwide. Jim Balsillie, the enterprise-focused co-CEO, built relationships with IT departments and government buyers, reinforcing the idea that BlackBerry was the only choice for serious work. Touchscreens, by contrast, were seen as a distraction. Internally, there was deep skepticism, and executives questioned their reliability and doubted that anyone would trust critical work to a glass panel. Leadership's worldview was shaped by years of success, selling to organizations that valued control, oversight, and robust security above all. Consumer features like music, web browsing, and games were considered secondary, even risky, because they could undermine the device's reputation for professionalism. This philosophy became institutional. Product roadmaps prioritized keyboard improvements and secure messaging, not entertainment or touch interfaces. The company doubled down on what had always worked, confident that the market would continue to reward their focus. As a result, BlackBerry developed a blind spot, the belief that the future of mobile belonged to the keyboard and that consumer trends could be safely ignored. In June 2007, Apple unveiled the iPhone and redrew the boundaries of what a smartphone could be. The industry press erupted, calling it a revolution. Inside BlackBerry, the response was measured and at times dismissive. Co-Chief Executive Officer Jim Balsillie told reporters that it was okay and they would be fine, while Mike Lazaridis questioned whether anyone would trust their business to a device without real keys. The company's public statements doubled down on the physical keyboard, pointing to years of market data and user loyalty. BlackBerry leadership viewed the touchscreen as a novelty, not a threat. In interviews and investor calls, executives insisted that business users needed accuracy and speed, qualities only a tactile keyboard could deliver. As iPhone sales accelerated, BlackBerry leaders stuck to their playbook. Rather than pivoting, they introduced hybrid models like the BlackBerry Bold, combining a small touchscreen with the familiar keyboard. These devices were billed as the best of both worlds, but the market was shifting elsewhere. The press began to question whether BlackBerry understood what was happening. Headlines from 2008 and 2009 show a growing divide. Apple and Google were chasing consumers, while BlackBerry defended its enterprise stronghold. Inside the company, resources stayed focused on keyboard-centric products. The leadership's refusal to treat the iPhone as a real competitor set the course for what followed. BlackBerry's belief in its own formula was so strong that it overlooked the changing expectations of millions of new smartphone buyers. The company's public posture was confident, but the ground beneath it was already starting to move. Inside BlackBerry, the challenge of adapting to a new era quickly became a struggle over resources and direction. Engineering teams found themselves split between two worlds, maintaining the legacy BlackBerry OS that powered the company's iconic keyboard devices, and building a next-generation platform based on QNX, acquired in 2010. Instead of a unified push, the company ran both tracks in parallel. Each group fought for engineers, funding, and executive attention. Budgets became battlegrounds, with leaders defending the systems they knew best. Product managers, for the established operating system, argued that the core business still depended on incremental improvements and enterprise stability. Meanwhile, the QNX team pressed for rapid innovation to catch up with iOS and Android, but struggled to pull talent and resources away from the entrenched legacy side. This dual-platform approach created deep silos. Developers working on BlackBerry OS optimized for reliability and security, while the QNX group tried to deliver features that would appeal to consumers and app makers. Communication between teams broke down, and priorities shifted with every quarterly result. Internal reports described mounting frustration. Deadlines slipped, and new products were delayed as teams waited for decisions or integration support. Political infighting over which platform deserved investment slowed every major initiative. The company's structure, once a strength, now trapped it in a cycle of indecision. While BlackBerry debated internally, rivals moved with speed and focus. By 2011, iOS and Android together accounted for 99.6% of global smartphone market share, leaving BlackBerry's split efforts isolated. The company's inability to choose a single path meant it delivered neither the stability enterprise clients expected nor the innovation consumers demanded. This organizational paralysis set the stage for a collapse that would soon become impossible to reverse. By the end of 2016, BlackBerry's global smartphone shipments had collapsed to just 207,900 units in the fourth quarter, down from tens of millions at its peak. Market share charts from Gartner registered the company's presence at effectively 0.048%. The collapse was not just about hardware. As users abandoned BlackBerry, the developer community left as well. App Annie data shows the number of new apps for BlackBerry World flatlined, while iOS and Android attracted waves of new developers. Alex Saunders, who headed developer relations, described the struggle to keep talent interested as a losing battle. High-profile apps disappeared from the platform, and the remaining catalog grew stale. Developers chased opportunity where the users were, and by 2016, BlackBerry's app ecosystem was a ghost town. The tipping point had passed. No new product or incentive could reverse the exodus. The BlackBerry Storm was rushed to market in 2008 as a direct answer to the iPhone. Instead of winning back consumers, it quickly became a warning sign. Verizon's return rate for the Storm topped 40%, with some estimates running far higher. Reviews called it clunky and unreliable, and the device failed to deliver on basic expectations for a touchscreen smartphone. The Storm's flop damaged the brand's reputation and drained resources that could have fueled real innovation. Years later, BlackBerry 10 arrived with promises of a fresh start. But it was too late. The new platform launched in 2013, 5 years after the App Store had already locked in developers and users elsewhere. BlackBerry still held billions of dollars in cash reserves, but money alone could not buy back lost time or trust. The core lesson is clear. Denial of market shifts, not lack of resources, destroys leaders. 4 warning signs stand out: protecting legacy products, delaying bold pivots, ignoring ecosystem health, and letting internal politics drive decisions. Today, even industry giants can fall, not from competition, but from refusing to see change coming. BlackBerry's fate isn't unique. Studies show over half of Fortune 500 companies have vanished since 2000. In technology, survival belongs to those who reinvent before the future arrives. What will we miss next?